You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit Verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
We're talking real money, serious money. We are so serious about money, we can't even smile. We're just serious.
Did you say serious money?
Serious money. We are serious about real money.
Okay.
Really serious about money. Yes, we are. And that's why we talk about it all the time. Or at least a couple hours on Saturdays on Como, which turned into a podcast. And you get to talk with us about it at 855-935-TALK. 855-935-8255.
If you've never called the show before, any question that's financially related, Don mentioned food last hour. We're not going to get into food. I'm a great consumer of it, but I don't think I'm that great of a Epicurean to get into it.
Yeah, so, you didn't know what a plantain was. That's true.
No, I was not. That does not bode well for my culinary expertise.
You're such a Northwesterner. You know, it's like
I can cook a salmon.
Plantains don't grow in Seattle.
With the best of them. No, that's true.
All right.
Cook a salmon with the best of them.
I have a question for all of you at home. You already know the answer, so this isn't for you.
Oh, okay.
All right.
Good. Thank you.
So all of you wonderful American investors out there, you have two choices. You have the American stock market. You got our good old-fashioned 100% American stock market, or you have them darn foreign stocks. All right?
I think somebody did refer to them earlier.
It's foreign stocks. You got them foreign stocks and the good old USA. Now, which one of them groups of stocks do you think outperform the other over time? Who wins most of the time? Who is the big winner of the stock markets, U.S. or foreign?
Well, I'm an American, so I'll go with America.
Yeah, that's what most Americans will do because most Americans invest heavily in America. Do you know, this is according to Vanguard, that 81% of our equity portfolios in the United States, 81% invested in American stocks. American.
I think it used to be like 85%. By the way, we're not alone with that, with home bias. You go to Germany, it's somewhere in the 80s. Japan, I think somewhere around 90. Yeah. People have a tendency to believe in the place they live. I get that.
Because they live in the best place. But here's the reality. U.S. stocks and international stocks, which is the more polite way to refer to them.
Thank you.
You're welcome. It's more politically correct. They split almost evenly.
In terms of
when they have a good year, half the time the U.S. beats international, and half of the time international beats U.S. 50-50.
That's one reason to put half your money in international, half in the U.S. You know the other reason?
Why? What?
Because about half of the value of stocks is in the United States, about half is outside.
Exactly. Why do we buy U.S. stocks? Because we hear this all the time. Well, I buy them because I know them. No, you don't. Do you? No. Let's say you own a portfolio, the entire U.S. stock index portfolio, which we know has about 8,900 stocks in it. Can you name all 8,900 stocks? Can you even name all 8,900 stocks in the portfolio, much less tell me what most of them do?
Don't forget to add Airbnb and DoorDash from this week.
Okay, so it's 8,902.
My guess is somebody else went out of business.
Oh, okay.
You do not know. No, people don't know. And that, by the way, that's one of the absolute horrible things that the fool started 25 years ago, telling people only buy the stocks in companies that you are familiar with. You know what they do. No, you do not know what they do. I'm sorry, you don't.
No. Do you honestly think that all of those people who worked for Enron, which was one of the largest energy companies in the world at the time, or at least appeared to be, they were heavily invested in Enron stock, and they claimed to know what Enron was doing. So apparently they either knew Enron was cheating or they were wrong about knowing.
I'll go with the latter.
Yeah. You don't know. Stop pretending you know things you can't know, and it doesn't impact your patriotism. Your patriotism is not questioned. No one is going to question it if you have half of your portfolio invested in stocks of the rest of the planet. Because bear in mind, those companies are companies you may think. For example, did you ever have a Nestle Crunch Bar? Are you eating American?
Yes.
Or are you eating foreign? You're eating
I think
foreign.
that's Swiss, right?
It's Swiss.
Yeah.
Yeah. You drive a General Motors car, you driving an American car, or a foreign one? Foreign.
Yeah.
They're made in Mexico or Canada. You drive a Nissan. What are you driving, an American or foreign car? Made in Tennessee.
By the way, here's another thing to consider. A lot of people think, well, I own Microsoft stock, and they send a lot of their products overseas, so I have exposure to overseas. And the reality here is that most of the return from those international stocks comes from economic activity in those countries. It does not come from us selling whatever product to those customers.
No. And the reality is, this is the other thing. We talk about this all the time. Having a portfolio split between U.S. and international stocks has saved your derriere when the U.S. market has performed badly like it did in the 2000s. You need this diversification.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
I'm dreaming of a white Christmas. Just kidding. You know, the Weather Channel app now has their long-term forecast, and I can check to see if there's any chance of me enjoying a white Christmas this year.
What are the odds?
The results are the same as every other year since I've been in Florida.
0.00?
Yes, zero chance.
What about Virginia? What about Virginia?
Virginia, it could, it's actually, if the weather, it's going to get rain, and it's going to be like 35.
Yeah, so you're right on the edge there.
You're right on the cusp, but I'm not going to be in Virginia. I'm going to be in Florida.
Oh, you're staying there.
Yes.
Well, I did just read Tom Brady said he'd never go north again, so maybe you shouldn't either.
No, I'm going to go to Virginia. I like that.
All right.
We
lost Dave, so
right now in southwestern Virginia. Oh my gosh, COVID, horrible.
Oh, is that right?
Horrible. Oh, so depressing. I just don't want to go anywhere. Give me a shot.
That's smart.
Yeah, I'll probably get the shot for my birthday in June. Happy birthday. Ow. Okay. 855-935-TALK is our phone number, 855-935-8255. If you need some money help, we definitely want to provide that to you, helping you build a better future, make more money, and you can also send those questions in. Keep more. Absolutely.
Yeah.
And you can send them in to us at talkingrealmoney.com, too. We even got one. We got a lot. You want one of those?
Sure.
You ready? Okay.
Yeah.
Do you have something to keep track of, like write stuff down?
Oh, gosh. Yes, I've got something. It's me. I got a pen, of course.
Okay. Well, because this has got a lot of letters in it.
All right, go ahead.
It's got a lot of symbols. The topic is changing from one index fund to another.
Mm-hmm.
Hi, guys. I have a Roth IRA at Schwab that contains a mix of index funds, large cap, mid cap, small cap, international, and emerging markets. That one's an ETF, in parentheses. Most are Schwab funds except the mid cap. When I opened the account, Schwab didn't have a mid cap index fund, so I bought PESPX. Ooh, I better look that one up because I don't know what that is.
PESPX.
Do you know what that is? You don't know that.
I don't.
Hold on, I'm going to look that up because we got to know to go forward. What did I say it was?
PESPX.
Thank you
for
keeping track. I asked you if you had a pen. Oh, it's the
Mellon.
Bank of New York Mellon Mid-Cap Index Fund. Okay. All right. Now we know where we are. Now Schwab does have a fund, SWMCX, which is much cheaper. Holy cow, is it cheaper? 0.04% to 0.51.
Yeah, right.
Also, the international fund you guys recommend on your website is cheaper than the one I have, SCINX 0.87 versus SWISX 0.06. In addition, both the cheaper funds have higher year-to-date returns. Yeah, they're cheaper. But I don't want to switch just to chase higher returns since there's no guarantee that trend will continue. They're index funds. There is no trend. I'm trying to decide if I should switch the funds, but two things scare me. One is I've always heard only invest in funds with at least 10-year track records. And SWMCX is only a couple of years old. The other is that a study showed that the most successful investors... I'm sorry.
You can't even get out the question? Come on.
The other is that a study showed that the most successful investors are actually dead people.
Because they don't care as much. They don't move their money around. They don't trade a whole lot.
And that
you could hit them with a real low return, and they just like...
And that the statistics say that most people get lower than market returns because they mess around and change their investments rather than leaving things alone. Is it
like dead people do?
That's right. You were right.
They don't move things around, yeah. Transaction fees are much lower.
Yeah. Okay.
I wonder where St. Peter is on all this, because you could check with him when you get there.
I am so dead. I just can't move my money. Is it worth it to change to the other funds to lower my fees, or is it better to stay put? I know asset allocation has more to do with success than fees. So I don't know if I want to mess with things if it's not worth it. If it matters, no, it doesn't. The rest of this doesn't matter. Go.
All right. So first of all, if you're buying an index mutual fund or exchange traded fund that holds thousands of securities at a low cost, I don't think it matters that it's been around 1, 3, 5, or 10 years. I don't think that's relevant.
Because the index has a history.
Yeah, I mean, if you're buying an actively managed fund where there's a brand new guy came in shiny suit, then I'm going to show you how to pick Tesla instead of...
Yeah, what we're doing is we're confusing issues. The advice that you're quoting is advice that is given to people who are chasing the hot stuff.
Yeah.
If you're buying indexes, it all becomes moot.
And by the way, generally... we don't set out to own mid-cap stocks. That's a separate discussion, but we generally do not. Because the action, when it comes to stocks, tends to be more on the fringes, the big and the small. That's where more of the ups and downs. But set that aside. If I was even if I had a portfolio and I was looking at it and I said, well, this one's owns the same assets, basically, and they do it at, it was like 1/10 of the cost. That's a no-brainer to me. I would simply move that over. You're not chasing returns. You're not changing styles, which is something you don't want to do. You're simply holding the same asset class at a much lower cost.
And the only issue that could possibly exist that does not exist in your case is taxation. Because you're in a Roth IRA. This is a Roth IRA. So therefore, taxation is no longer an issue. To me, this is really easy, except I'm with Tom. I would do one minor change. I would make sure I had the lowest cost large cap index fund, the lowest cost small cap index fund, the lowest cost international index fund, the lowest cost emerging markets index fund or ETF, and I'd skip the mid cap entirely.
Now you missed value. There.
She doesn't have value in there, but yes, there should be. As a matter of fact, I would make my small cap instead of small cap. I would make my small cap value.
There's been far better returns using that asset class. I think that's great. I think that's and by the way, that would be the same today, tomorrow, next week. That wouldn't change. That's again, you're not making a style change. You're simply saying I want to be better diversified, tilt a little more to small and to value, and pay less in expenses. That's good.
And there is only one certain way to increase your return. One.
Bitcoin?
Wrong.
Tesla?
Wrong again.
Airbnb?
Wrong for a third time.
DoorDash?
You're out.
Okay, that's it.
Here. Yeah.
Baseball might come back. Yeah, go.
Tom Cobb disqualified.
It wouldn't be the first time, by the way.
No, the one way to improve your returns. You said the returns on these cheaper funds were higher. They're higher because they're cheaper. That's why they're higher. The returns
are higher because you're paying less to others.
Exactly.
That is
math.
One guarantee. That's true. That's true.
Math.
And by the way, every act, I still love this argument. Every act, as I just heard it recently too, every active manager, American funds, for example, they're going to tell you, well, yeah, you're paying us more, but we got really smart people that are buying and selling stocks that'll make you more. Sadly, that has not been the case. So.
No evidence. None. No evidence. No. Show me the evidence. Evidence. Evidence is essential in almost any argument. Not getting political at all, Don. 855-935-TALK is our number. 855-935-8255. Call anytime.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
What's our favorite thing to do? Answering questions from you. We love to do that. We do. We like that. We do it all the time.
But only if you're
we do it.
going
we
to a
do
zoo.
It for fun. Oh, if that was
and
not
if your
a
friend
Dr.
is named Lou,
Seuss rhyme.
And as long as the answer doesn't smell like PU.
Do you like green bills and ham? Tom has got it, Sam. I am.
I got a lot of ham. That's for
yeah,
sure.
exactly. That's why I went that way.
I like it. A lot of ham.
Want another question? Because we don't have any. The number, 855-935-TALK. I'll just give you that
You're
again.
going to talk to us.
855-935-8255. You can also send them in at talkingrealmoney.com.
And there's Teresa right there.
Oh, well, then we won't do that question.
Her hand up.
What? You got her?
Teresa.
Yeah, all right.
She's ready to go.
Hey, Teresa, welcome to Talking Real Money.
Moving to the front of the line.
I have a question. I closed out a fund. I closed out some stock from an old employer, and then I got something in the mail, and I said, "What is this?" I closed that out. They said, "Oh, that's the contribution the agency gave after you cashed it in," and it was like $148 or something. But the fee is $150, and that was over a year ago, so we're going to charge that. And I said, I don't think that's fair because I already paid the $150 to close it out a year ago, and I didn't even know about this money. So they said they're investigating it. But what are my rights? I mean, that's not fair to charge me twice.
Oh, wait. Okay. All right. So they charged you $150 to close out the account a year ago.
A year ago.
Okay. And
is this a major brokerage, or what kind of account was it?
No, it's just a small. It's just a small company in Tacoma, Washington.
But this was your employer,
fund.
Or this was an investment advisor or a broker.
It was through the agency that I worked for. They
so an employer plan.
Okay. And I'm just trying to follow. So you paid the $150 a year ago, then they sent you $148?
No, they said that's what's left in my account, and I said, what is this statement? It was hard to read, and so I called them. Oh, well, you have $148 left in that.
Okay.
The fee is $150, so they're just going to eat it up.
Oh, I see what you're saying. So to take the 140
a year ago. Yeah.
Oh, let me tell you. Let's talk rights. You don't have many. Trust me on this, you don't. It's not worth getting a lawyer. Most of the regulators are going to go, eh. What I would do is go to the manager, the head of the company or the head of the plan, whoever the trustees of the plan, and say, okay, here's the deal, guys. We got this extra payment that got kicked in after I liquidated. It is patently unfair. It may be perfectly legal, but it's patently unfair to charge this. Will you please, and you say it nicely, will you please, in this case, make an exception?
Well, that's what I asked them. They said they were going to investigate it, but
that's good.
Wondered,
but what you don't have any special legal rights of which I am aware, because who would?
No, I'll tell you why. I don't have any rights. You know who writes all these laws? All the securities business.
Yeah.
All those people, they wrote. It's like arguing with the bank about something. They're going to say, well, here's the regulation. We wrote the regulation. So, no, I agree with Don. I would go to either the head of HR or the head of, depending on the agency, the size of whatever institution, and say, come on, let's be fair about this. This is not right. Do it in a gentle manner to begin with and see where it goes. But I don't think you have any reason to hire a lawyer or do anything like that.
And plus, you're going to have the only regulatory body that might have some say is a Department of Consumer Affairs or an Attorney General, and $150 problem, they're just not likely to touch it because they have so much other stuff on their plate. So that's what I would do. I would just ask nicely and then ask nicely again and then ask nicely again, and then on the fourth time yell. 855-935-TALK.
I think that's good advice. I should take that advice because I always do the yelling first and then ask nicely later. Thank you, Don. Thank you for the reminder.
935-8355. Give us a call. We got a line open. 2, 3, 4 of them. I don't know how many lines do we have anyway.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Reality radio for a really great future. We're talking real money.
We are indeed with you, because it's an important part of your life. Hi, I'm Don. That's Tom. 855-935-TALK is our telephone number, and we have a lot of time. We'll try to help you manage money issues of any kind. 855-935-TALK. And Bill, you're up next. Welcome to the program.
Hello, Bill.
Hi, thank you very much. I have a question. I bought 2 ETFs. And I just want to kind of know what I bought and if I should keep it or how I should deal with this, because this is the first time I've ever used or bought any of these. And it's DRV and SRS.
Hold on. Looking them up. DRV?
Thank you.
DRV, the Department of Regular Vehicles. Wait a minute. Hold on a minute. Wait a minute. What was the other one?
SUX?
SRS.
SRS.
Photo
right,
share, ultra short.
Oh yeah, we're gonna have a little chat here.
Oh boy, there's a nice write up about all this in the Journal today. By the way,
yeah, we're gonna have a little chat. Be prepared for a little chat. You bought the Direction Daily International Real Estate Bear 3X ETF. With an
you understand what that means?
It's the DRV.
Yeah. What is that?
No, do you understand what that is?
A little bit. It's about maybe the market for housing going down. And
why did you buy that?
I was talking to a friend, and he was mentioning it, and I thought, well, the housing market is pretty high. It's got to go down eventually. So, and the prices seem pretty low compared to how it's been over the last year or two.
What you are doing right now, Bill, and really, I this is so important. You are right now. You are officially gambling. That fund
just like
is, yeah. Let me just explain to you. That fund, that ETF has been around for a long time. Let me just run some numbers by you. You ready? In 2010, that fund lost 72%. In 2011, that fund lost 56%. In 2012, it lost 47%. In 2013, it lost 22%. In 2014, it lost 59%. Year to date, it's lost 57%.
Setting aside the returns just for a moment, FINRA, the Financial Industry Regulatory Authority, has warned that these type of ETFs, quoting now, typically are unsuitable for retail investors who plan to hold them for longer than one trading session. These type of products are developed for these are developed for professional investors who are looking at short-term trends and what's going on in particular parts of the market. They're being traded in and out. Honestly, I don't even think this sort of product should be made available. And by the way, this is a product that I hate to read is being promoted by Robinhood, for example, for people to get in and see I can make a quick dollar. No, this is a way to lose a lot of dollars in a very short period of time. This is not a good product.
Oh, no, this is so dangerous. If you want to lose your money, you have made a really good bet. You're very likely going to lose not just a little, but almost everything.
Well, I guess I'm up $43, so maybe now just get out and call it good.
Bail! Bail! And the other thing about these is that they're incredibly expensive to boot. They have very high fees. They are just beyond dangerous. They are literally, this would be like you betting on black.
Yep, putting a lot of money on black.
Yeah.
And that's the reason I called, is I started reading up and it said, yes, this is the kind of thing you hold on for a day. And I was like, oh, hold on.
Yeah.
Unsuitable. I think it should just say unsuitable for retail investors, period.
Yeah.
This is for a trading pro.
By the way, this is an important question just for everybody listening. How did you buy this? Through what trading platform did you buy this?
I have a Schwab account, and so
Schwab should have put a warning up. Did Schwab put a warning up?
There was.
Warning you that the.
Yep, there was.
Okay, there was a warning.
Yeah.
All right.
That says you should be a sophisticated, experienced investor.
I read the warning from Schwab.
Okay. Yeah, Bill, time to get out. And in the future,
Thank you guys very much
no
for the
gambling
info.
with your hard-earned money.
Just use index funds, be widely diversified and balanced between risk and return. Don't make bets on what you believe, by the way, is going to happen in any part of the market, real estate, stocks. No reason to believe that your bet is going to be any better than the next. And you heard those returns.
Remember, what you believe is just that. It's not what will happen. It's merely what you believe. And you're as likely to be wrong as be right. You can't know. Don't bet. 855, unless it's just for fun and you're trying to get free drinks. 855-935-TALK is our number, 855-935-8255. Give us a call, and we'll try to make life a little bit simpler.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK. I have one more quick little message about the short funds. Not short as in short term, but short as in they're betting against the market funds like these real estate funds.
Thank you. They're betting against the price of a security.
Right. They're betting against real estate.
And they're doing it with leverage.
Right. Now, we talk about average annual returns a lot on the show. For example, we might say the stock market had an average annual return of 9+% per year over the past 90 years. We might say that. What has been the 10-year average annual return of these real estate negative bet funds?
Betting against the rising prices in real estate.
I have never seen a number this big in an average annual negative return. Over 10 years, a negative 40% per year.
And by the way, the people running those funds will say yes.
Yes.
They'll say yes because the people that own them should be traders, people that are moving it. They're not just buying it and holding it for a decade. They'll admit that.
Right.
And that's another reason for you not to own that product, period. Period.
Okay, 855-935-TALK is the number to call. And do me a favor, before you buy this kind of stuff, just call quick or send us a note. Sue, you're up next. Welcome to Talking Real Money.
Hi, thank you for taking my call. Can you hear me?
We can. Thanks.
Yes.
Sue.
Oh, hi. I have a couple of questions about my 401k.
Okay.
I'm 63 years old. I have around, last time I looked, $450,000 in my 401k. I have two daughters, 26 and 32. My question is, if I die, what will happen to my 401k? They are my beneficiaries, but I'm just wondering about how it's going to be distributed in the timeline.
Well, it kind of goes like this in an employee.
Or earn interest.
Yeah. It can stay there for a short period of time, yes, but your daughters will be notified. Hopefully they're aware of your passing anyway, but then they would have to open an account for that money to go into, and then it would be theirs to use as they wish and pay tax on it. So this is not an untypical scenario for a employee retirement or employee sponsored plan.
So they're going to get it pretty much right away.
It takes a little while, but not a long time.
What will typically happen is your daughters or the executor of the estate will go through your assets and get certified copies of your death certificate, present them to those custodians, and those custodians will then distribute the assets to your daughters.
And that would be automatic, by the way, in an employee retirement plan or an IRA, for that matter. It would not necessarily go through probate.
No, but they would still have to have a
directly.
death certificate.
Correct.
Yeah. That's all.
Oh, it will.
And by the way, this is another.
Did I hear? Did you say it will not go through probate?
No, it will not go through probate.
Yeah, these assets go directly. And by the way, are you still working there?
Yeah, I'm still working at the same company for almost 40 years. I don't plan to retire, but just wondering if I did retire today for whatever reason, if I quit, what will happen to my 401k? Do I keep it there?
You can.
You could.
You can.
But, I mean, again, one reason you might not want to is for the reason you just mentioned. It is far easier for the assets to be moved from an IRA to an inherited IRA than it is from an employee-sponsored plan to an inherited IRA. So that might be a reason when you do retire, and I hope you do at some point, to roll that out into an individual retirement account rather than having it still in the employer-sponsored plan.
What is the drawback for leaving it at my employer plan?
It's just it's a multi-step process. It's just slightly more complicated to go from the 401 to the IRA to the inherited IRA, just another step. Whereas if you have it in an IRA, let's say with Schwab or Fidelity or Vanguard or whoever it might be, you pass, your assets immediately or almost immediately go into the inherited IRA in the names of your daughters.
Okay.
And with an inherited IRA, they have 10 years to take the money out before they have to pay taxes.
Good point.
10 years
under the new rules.
The money out?
10 years they have to withdraw, and they have to withdraw the money out and pay tax on it. They don't have to spend it, but they have to take it out of that account and pay tax. That's the part that
but they get 10 years
the government
to do it.
Cares about.
Okay, so the penalty or the tax won't be so great.
It can be dragged out over a long time, and they can do some tax planning to determine the most opportune time to pay that. Yes, ma'am.
Oh, that's
all right.
Good information.
All right.
Can I ask
Thank you,
one
Sue.
more question?
Sure, absolutely.
If I want to give my daughters some money now, pull out from my retirement account without penalty, how is that? How is it done?
Well, at your age, at 62, I couldn't hear you, 62 or 63. 63. You take the money out. That depends now on the plan. Your plan may or may not allow you to take money out while you're still working there. Most plans at age 63 will allow that. Mm-hmm. There's no penalty. You're going to have to pay, though, the income tax on that. They're going to probably withhold 20% of whatever you decide to take out. You're paying the tax. You hand it to them. They can do whatever they like.
Right, and there's no tax to your children.
20% tax.
You would have to pay your tax. You would have to pay your whatever your income tax rate is. You would have to pay taxes
withhold.
because remember the money went into your 401k pre-tax. So when it comes out, the IRS says, "Well, we gave you a deal. It's been sitting there growing tax deferred. You didn't pay any taxes initially. Now you got to pay taxes at your income rate." So you will, but somebody's going to pay the taxes someday anyway. So it really doesn't matter when they get paid. And thank you again for calling, Sue. We really appreciate it. Guy, you're next. G. Oh, G.
Yeah.
G?
Get that right?
Hi there. Thanks for taking my call. Yes, correct. Yeah,
Good.
how you doing?
Good. What can we do for you today?
Got a little complex question to ask. I recently went from a transition between a public company, a non-profit to a state employer. Mm-hmm. And the 401k that I hold is with Fidelity as the bookkeeper. Within that 401k, I did also open a brokerage-linked account and hold a couple of positions of stock.
Now, here's the issue.
Me a date.
Gee, we only have 1 minute, so we're going to have to go really fast.
Okay. Yes. So, I mean, they cast me out before the date that they actually announced that, if you don't do anything to your account, then we're going to cast you out. But, they cast me out 4 days before that. Is that something that I can take it up and trying to fight for it? Because the position I hold back then has appreciated quite a bit since then.
Probably not, but certainly you should go back to a supervisor there at Fidelity and see what the reasoning was or who caused that to happen, whether it was your company or them, and take it up with them. But my guess is probably little or nothing you can do. It's just a lump that we take in life. Thanks for the call.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
In addition to calling us anytime at 855-935-TALK, you can call 24/7. We'll answer your questions on the podcast. If you have a more complex, convoluted issue or you need to get started on your plan for the future and the future of your investments, make an appointment to meet with one of our advisors. It's free, no obligation, no sales pitch. Just go to Vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.